And bearing in mind the lengthy aftermath of the Great Recession, we understand that aggressive federal stimulus is essential to building our way out of a deep downturn. This one is worse than 2008. It stands to reason we will need to invest more, not less. So the concern about pandemic spending is not about our aims or our intent. It's about capacity. Canadians are careful about their nation's finances. I know this very personally. I'm from rural northern Alberta, which is not, culturally, a place much steeped in the ideas of helicopter money. And the question I hear from there, and here in downtown Toronto too, is this: can we afford it? I'm going to start with a simple answer, and then I will elaborate. La réponse est simple. Oui, nous le pouvons. Permettez-moi de vous dire pourquoi. D'abord, nous sommes entrés dans la crise avec les moyens financiers dont nous avions besoin pour réaliser notre plan. C'est un fait et non une opinion. Quand la COVID-19 nous a frappés, le Canada avait le plus faible ratio de la dette nationale au PIB parmi les pays du G7. Aujourd'hui, même après la plus forte explosion de dépenses d'urgence depuis la Seconde Guerre mondiale, le Canada devrait conserver le plus faible ratio de la dette nationale au PIB au G7. À notre solidité financière relative s'ajoute la conjoncture économique mondiale. Les taux d'intérêt ont rarement été aussi bas, en particulier pour des piliers économiques comme le Canada. Malgré nos dépenses sans précédent pour lutter contre le coronavirus, les frais d'intérêt qui incombent au Canada en ce moment n'ont jamais été aussi bas en 100 ans en proportion du PIB. Vous avez bien compris, au cours du dernier siècle, on n'a jamais payé aussi peu d'intérêt sur notre dette par rapport à la taille de notre économie. So, the simple answer is, yes, we can afford it. And let me now tell you why. First, because we entered this crisis with the fiscal firepower to do what we need to do. This is a fact, not an opinion. When COVID-19 hit, Canada had the lowest net debt to GDP ratio in the G7. Today, following our country's most aggressive burst of emergency spending since the Second World War, Canada is still expected to have the lowest net debt to GDP ratio in the G7. Added to our relative fiscal strength is the prevailing global economic climate. Interest rates are at historic lows, particularly for fiscal stalwarts like Canada. Notwithstanding our unprecedented spending to fight the coronavirus, Canada's interest charges as a share of GDP today are at a 100-year low. That's right. Today, we are spending less to cover interest on our debt relative to the size of our economy than at any time in the past century. To put this in perspective, in 1995, Canada's debt servicing costs as a percentage of GDP were 6%. Today, even after the unprecedented expense of battling the pandemic over these past months, that figure is expected to be 0.9% of GDP. And we are locking in these low costs by issuing more debt into longer-term instruments, at these historically low rates. Now, for Canadians of a certain vintage, and I freely admit to being one of them, the idea of increasing government debt holds particular terrors. We remember the fiscal shock of the 1990s when Canada flirted with insolvency. And especially among those of us who cherish the accomplishments of Paul Martin and Jean Chrétien, we remember how Canadians heroically and through great sacrifice climbed our way out of that debt purgatory and built up the fiscal war chest that is serving us so well today. Both the terror and the triumph were formative for a generation of Canadians. But it's a poor general who fights the last war. And the reality is that today, the prevailing global economic environment is changed entirely. In fact, not one of the factors that drove the fiscal crisis of the 1990s holds true today. Let me repeat, not a single one. It's true that interest rates easily outpaced growth in the 1980s and 1990s. But as Olivier Blanchard, the former chief economist of the International Monetary Fund, pointed out in a seminal paper last year, those 2 decades seem to be an anomaly. Over the past 80 years, with the exception of the 1980s and the 1990s, the pattern is the one we see today, where growth exceeds interest rates. As we look ahead to an industrialized world with an aging population and a tendency toward secular stagnation, deflation and subpar growth seem likely to pose greater risks than the twin threats of inflation and spiraling debt that Mr. Chrétien and Mr. Martin successfully countered in the 1990s. The upshot is that we are living today in a world where the risks of fiscal inaction outweigh the risks of fiscal action. Doing too little is more dangerous and potentially more costly than doing too much. And this is not an idiosyncratic view. It is the new consensus, including among Canada's major banks. Let me quote, "While interest rates are extremely low," the IBC Capital Markets said in a note last month, "governments can and should ramp up borrowing and spend to cushion the economy from COVID's wrath. Larger debt loads are also less of a scare story if, as we expect, we don't see a return to the interest rate environment of the 1980s and 1990s." End quote. Just as there are no atheists in foxholes, it seems there are few disciples of Ayn Rand in a pandemic. We're all in this together. Now, even as I utter these words, I feel what may be a peculiarly Canadian discomfort. We are, after all, the inheritors of a society built on the ideals of peace, order, and good government, rather than the seductions of revolutionary change. Caution is a very Canadian virtue. But let's also remember this. Canada is a hugely diverse country built by the resilience and wisdom of Indigenous peoples and the courage and endurance of immigrants who bore great risks to build new lives here, as well as their descendants. As Margaret Atwood concluded in her groundbreaking survey of Canadian literature, we are, first and foremost, a country of survivors. And one of the first lessons of survival is that you must do whatever it takes, whatever you can, when the wolf, advocating expansive fiscal policy to battle COVID-19 and to grow our way out of the coronavirus recession. I am not among those who think Canada should have a fling with modern monetary theory, which holds that deficits don't matter for a government that issues debt in its own currency. Whether on Bay Street or on Main Street, there are no blank checks and there are no free lunches. Our fiscally expansive approach to fighting the coronavirus cannot and will not be infinite. It is limited and it is temporary. A smart and careful government, and those are two adjectives I would use to characterize our policy, will impose those limits upon itself rather than waiting for the more brutal external restraints of international capital markets. I will have further thoughts to share soon about the fiscal rules and limits by which we will govern ourselves. Today, we have a moral imperative, but also a hard economic imperative to fight the coronavirus with all our might and to provide our people and our businesses with a bridge to get through to the other side. As we beat down this virus, we will need to provide meaningful investment to build our way out of the coronavirus recession and to ensure our economy comes roaring back, stronger than before. That will mean laying a foundation for an innovation economy, for a green economy, and for a fair economy that supports good jobs for all Canadians. It means ensuring that our recovery is long-lasting, robust, and equitable. And as that occurs, we will resume the long-standing, time-tested Canadian approach with fiscal guardrails and fiscal anchors that preceded this pandemic. For these are the very policies that left us so well positioned to meet this truly generational challenge. Today, I've cited historical experience and economic research to buttress my argument. But we've now been fighting the coronavirus for many months. We have some initial evidence about what actually works economically and what doesn't. And the good news is that Canada's COVID-19 response, from public health to support for provinces and territories and municipalities, to emergency economic programs that sustain workers and businesses, has fostered a promising, though still uneven, employment rebound. Economists from TD Bank noted last week that job growth in Canada now exceeds the rate in the United States, the international economy with which we are most closely tied. That divergence led the bank to suggest it may be time to amend the adage we all know so well, that when the US sneezes, Canada catches cold. Instead, the analysts offered, perhaps we should now say, when the US sneezes, Canada builds antibodies. I like the sound of that. Now, let me end these remarks by placing our own debates in an international context. 2 weeks ago, the fall IMF World Bank meetings took place, held virtually this year, of course. Two things struck me about those meetings. The first was the clear consensus that for countries that can afford it, now is not the time for half measures. Finance ministers from around the world agreed that the risk of withdrawing support too soon outweighs the danger of spending too much. Second, there was broad international agreement that with interest rates approaching zero, monetary policy is running out of bullets. That puts the onus squarely on fiscal policy to grow our way out of this recession. A generation ago, prudence meant deep cuts, public spending. Today, it means that we support our people and our businesses as they battle this pandemic, then move beyond it, and ultimately thrive in the recovery that will follow. It's notable that the leaders of the charge for expansive fiscal policy this year in 2020 are none other than the flinty-eyed economists of the IMF, formerly the high priests and chief theologians of austerity. As the Financial Times put it in an editorial